Hello there, my name is Christina Mackay. I'm the founder of INN. INN is designed to bring together investors, entrepreneurs and advisors. Today I just want to touch on valuing a startup. I've written a paper on this and that's available on inn.global, so you can just go into the toolkit and have a read of that. I just want to touch really briefly on some methods used to value a startup. But before I do that, I'd like to share that I'm trying to develop my own method of valuing a pre-revenue tech startup. And if you're interested in helping me develop that, I would love your input. It will be based around some core factors in a startup. So it'll include team, business model, market, product, service and technology, and business model. So if you're interested, please do comment below or join inn.global and private message me or chat with me live. But now let's talk about some existing methods and some of the pros and cons. So I'm going to start with cost to duplicate. Now that pretty much is what it says on the tin. It looks at your startup and it says, well, how much would it cost to duplicate all these different aspects? Now, I don't like this method. I think it's crude and I think it's a severe underestimate of the value of your business. And it suggests that you could just duplicate it instantly, which is not true if you don't have the people and the mindset and the resources and things like that. So, but you know, what does it do? Well, it takes the assets essentially and values the assets. So it doesn't take into consideration intangible assets. So your brand, your reputation, you know, understanding your customer base. Maybe you did some research and maybe you've built relationships. It doesn't take into consideration those things. So I personally don't like cost to duplicate, but it's good to know about it. Next up, we have the comparable acquisition method. Now this method I do actually think is a good method if you can do it. So I'll talk about that in a second because it's tricky. But comparable acquisition, essentially, it means you go out into the market and you try to find another company that is similar to yours that has been bought, so it's had an exit, or it could have done its initial public offering. So that's what you're trying to do, and you're looking at that company and saying, okay, well that say it sold to Google for £400 million. Now that doesn't mean that your business is worth £400 million. What it means is you do the comparison. So try to put it in two different bags, so that you have your bag and you have the comparable bag. Do you have maybe you have 100 customers, they might have 100,000 customers, and you might have one product line, they might have 20 product lines. So you just do that comparable method. So therefore, if they're worth 400,000, you might discount that down to what's in your bag. But it is a good way of understanding the value of your company. I said it's good if you could do it. So what I meant by that is it's very difficult to find a company that's really, really similar to yours, that's delivered the same product and service, that has the same values, the same type of people, the same resources, the same brand and reputation, the same relationship with the market. To find that company is difficult enough. Chances are it's not out there, it might not be out there. And even if it is, if it's a private company, a private sale, it might be very difficult for you to find out all those factors. All those elements of the business, how many customers they had, or how much revenue they were making, or how much it cost them to produce their goods. So I think it's a good method, but I think it's quite difficult to do. Now I just want to go on to the scorecard method next, because it does use a little bit of the comparable method. And what the scorecard method does, which I like, is that it introduces some more elements. So it talks about essentially it weights the strength of certain elements in your business. So your product or service, for example, or your team. And if those elements are stronger than the comparable acquisition, or the similar company in the marketplace. It does that by giving a factor, a weighting to each of those elements, and there's sort of 5 elements there. And then that comes out with a factor, and then you times that factor by the comparable company or comparable acquisition. Now that factor, that could be lower. So if your product is weaker, or if there's more competition, is competition stronger, then the factor will be weaker and your valuation will be less in that company. But it could be stronger, your team could be stronger, and things like that. So that's how you do that. Now I like the idea very much so But again, it relies on having this comparable company in the first place. And then the next bit in terms of the factor weighting, that's still finger in the air. Which, by the way, if you ask an investor, if you ask people, how do you value a pre-revenue tech startup, they will say, finger in the air. So the methods I'm talking about are just, I really consider them as frameworks, tools and sort of framework to go to try and think through how you could value the business. So next I want to talk about the venture capital method. Now this is a popular one amongst venture capitalists, and this one essentially values the company based on the expected end value of the company, so the expected selling price of the company or IPO, exit IPO, whatever that might be. So it tries to calculate that and then looks at the expected rate of return of the investment of the investors, and then values the company based on a formula which is provided on my on inn.global, so you can have a look at that. Now it's sort of mathematically based, so people like it for that reason, but I think that works with a revenue generating company, which if you're a venture capitalist you probably have invested in a revenue generating company, so it does make more sense for you. For a pre-revenue company, I think that method is still just finger in the air. So for pre-revenue, I think it's difficult to use. And similarly, the next method is discounted cash flow method. This is again a very popular one, so it looks at your cash flow and then looks at the net present value of your cash flow. So it's a calculation. Again, that calculation is provided on my website, so you can look at that. But in terms of pros and cons, again, I think for revenue generating companies it works very well because you're showing your forecast for the future, but your forecast probably have more credibility if you're revenue generating. So you say you expect to grow by 20% a year or 50% a year. That's much more credible if you've already started making money. For pre-revenue, I think that's difficult, and I think discounted cash flow is still finger in the air. So the next one we have is valuation by stage. Now this is not one that I hear used often because again it's quite a crude method, and this method is essentially to say if you have an idea that might be worth 50,000, if you have a team that might be worth 100,000, if you have your product, your service, your technology, that might be worth 200,000, and if you've launched and you've got traction, that might be worth 500,000. It's something like that. Those figures aren't bang on, but it's because I don't know anybody who uses that method because there's no substance behind it. So, but that just a method for you to know. So if you hear it, you know what they mean by valuation by stage. And then the final one I just want to touch on is the risk factor method. And this one, I suppose it has similar elements to the scorecard method in the sense that it has different factors involved. In this case, it's risk factors, and they weight those factors and they times it by a valuation of your business to get your final valuation. So it's, again, mathematically based, which is good, but in terms of the risk factors, that's subjective, and in terms of what you need to times that multiplier by, so a comparable acquisition or comparable company, you might not be able to find it. So again, they're all finger in the air methods, but the value of understanding these methods and the value of going through them and applying your own business to them, so applying your own cash flow forecast, or your finding your own comparable company, is that then that gives you a basis for negotiation. And that's what I want to help you with. That's what I want to help entrepreneurs with. Because the truth is, investors have done this maybe 100 times. So they've gone through price negotiation for a company, they've gone through valuations of a company. They, when they do finger in the air, it's because they've seen it several times, and so they tend to know more what they're talking about. But of course, they're going to want to reduce the valuation of your company so they get a better deal. Not always, but sometimes, let's be realistic. And so what I want to do is help the entrepreneurs have more of an understanding of the different factors that go into valuing a company, so that you have some negotiation tools essentially. so that when you go into that negotiation, you can talk about these aspects. You can talk about your discounted cash flow, you can talk about comparable acquisitions or comparable companies in the market. You can talk about the scorecard. You can say I've got a stronger team than a comparable company, or I've got a stronger product, or I've got some great protected intellectual property. So that's really the goal I have for talking about valuation. So I do have a PowerPoint presentation on this that goes into more detail, and as I said, a paper on this. So please do find those and read up about it. And if you have any comments and I've missed anything, then do let me know. And more importantly, this new method that I'm developing, if you want to influence it or if you want to start playing with it for your own business, you're more than welcome to do so. So let me know, either comment below or join inen.global, and you can private message me or chat with me live. Thanks so much. Bye.